And I don't think that the Fed or many of the people I hear discussing this really do understand how harmful this is to the underlying economy. You know, my letter to the Fed, which basically was asking the question, how can you be unanimous with these 75 basis point increases when these financial indicators are yellow at best, and really we thought flashing red. Real beneficiaries are going to be companies who have AI expertise, domain expertise, and critically a large body of data. And we think Tesla, the largest position in ARKK and ARKQ, and we even own it in ARKW because it's an AI company, it is probably one of the most important AI beneficiaries in the form of autonomous taxi platforms, ultimately, which are powered by AI. The mistaken assumption here is that Tesla has to cut prices because of competition. Tesla, we think, can drive prices down because its costs are moving down, particularly battery and drivetrain costs, faster than most other manufacturers.
In this video, Cathie Wood has some thoughts, a lot of them, including some directed at the Fed, who seem intent on absolutely destroying the US economy, ARK Invest's strategy and their performance over the last few years, Tesla electric vehicles EV adoption with a staggering prediction, Tesla's pricing power, and a little thing, something about proprietary data and autonomy and unassailable lead, and that kind of being extremely important to understand, especially if you own Tesla stock. And Cathie Wood does not hold back. Oh, and speaking of not holding back, I do have to bite my tongue a little bit here on YouTube. If you want some more spicy, unfiltered takes, head over to Patreon. More than 300 exclusive videos and continuing to count rapidly. You can join with the card in the corner or the link in the pinned comment.
Typically, when we know the Fed's going to pause, the market looks over whatever's going to happen tomorrow, and it may be 25 basis points. So I think we're there. I think the banking crisis has put us there. But I do think that, the Fed or the FDIC is here to save the day. I think that's too easy an answer right now. And I don't think that the Fed or many of the people I hear discussing this really do understand how harmful this is to the underlying economy. And
for what it's worth, I wholeheartedly agree with Cathie Wood here. At first, I was looking from afar thinking, what the fuck are the Fed doing here? I mean, there's inflation due to supply chain disruptions due to the fascist futile lockdowns during the scamdemic. Jacking up interest rates isn't going to affect supply chain disruptions that have caused materials, parts and other things to increase in price. Then I start thinking, hang on, what about all the people who have mortgages whose rates are going up and up and up and up and up? Surely at some point when you're starting from such a low base, basically 0%, a 0.25% increase in rates is enormous. If they're starting at 8%, a 0.25% increase is barely anything. The magnitude of the rate increases from the Fed has been staggering. I just literally cannot believe what I've been seeing. Of course, I'm no economist, I'm just some guy on the internet. But it seems to me at this point in time, the Fed is adamant, absolutely hell-bent on causing the US economy to implode. Millions of people to lose their homes due to mortgage defaults, car loans to go bad, business activity to slow down, investments. What? My best guess is that these morons who are looking at very lagging indicators in the rearview mirror, when they realize the harm they've done, will begin reversing course and doing so aggressively. The pendulum has swung too far in one direction, and I think the Fed is going to aggressively reverse course when they finally realize what they have done. Unless, of course, they're intent on destroying the US economy, and the ripple effects that would be felt more widely internationally as well, in which case, I'm not sure why, but okay. Keep doing what you're doing, Fed.
And our strategy tends to do pretty well when interest rates are coming down and when the cyclicals are weak. And I must give you and your team credit because you're raising this question more as people are saying, no, there are two things going on here. One's financial stability, one is inflation. Well, they are related. And if we're right, and deflation is the bigger risk here, and we obviously our conviction has increased. We've been saying this ever since last spring when credit default swaps started going up on the banks. We were saying, ooh, there's a deflationary risk. And then we had the inverted yield curve. And then, my letter to the Fed, which basically was asking the question, how can you be unanimous with these 75 basis point increases when these financial indicators are yellow at best, and really we thought flashing red.
These were fair questions. I covered Cathie Wood's open letter to the Fed maybe 6 months ago, give or take. You remember Cathie Wood? Hello, Fed. Are you listening? Clearly, Cathie, they were not. In fact, I still don't think they're listening to anyone. But that's okay. They don't need to listen to anyone because they're the Fed. They know what's best.
Well, you might get your wish. I mean, the Fed expected to raise 25 basis points tomorrow and then, according to the market, be done and start cutting, which I know would be helpful for you. But my question, Cathie, is the result of all of these issues and the lower rates is that the market now thinks we're headed for a deeper recession and starting to price in that, no longer the soft landing camp. And in that kind of period, wouldn't you want, especially technology stocks with better balance sheets that are more higher quality than the sort of newly profitable or unprofitable and riskier tech stocks that you're in?
Just want to jump in before Cathie Wood answers. The question, clearly from a trader mentality. Well, hang on. If the shit's hitting the fan, couldn't that adversely affect the valuations of companies you believe will completely change the world, disrupt everything, and make millions, billions, potentially trillions of dollars in the future? Yes, and that's a good thing, because if you're not a short-term trader, you buy these things when on a massive discount, hold them for a long period of time, they cause massive disruption, and you benefit from buying these things when they were dirt cheap at peak fear. Shout out to Tesla stock, which just a few months ago was down around 80% from recent highs. That didn't make sense. The stock almost doubled since that point in time, and it's still dirt cheap in my opinion.
Well, something very interesting has happened over the last year. Actually, over the last 2 years. So our strategy peaked out in February of 21. A lot of our companies had done secondaries when they were booming. The stocks were booming in 2020, early 21. And today what we find, now that they have the cash and they've been cutting costs, streamlining, our ARKK fund has a weighted, on a weighted basis, a runway of roughly 6 to 7 years of cash. And our ARKG fund, which is where we would have the most questions because they are very early stage, they have, and it's because the markets demanded it, been cutting costs, raising cash, and they have 4 years of runway. So we actually think we're in very good shape, and that interest rates coming down is going to be another booster. Again, it's the valuation hit of the last year that has been so severe to our strategy, February of 21 to today. And that was all related to the Fed jacking up interest rates 19-fold in less than a year. Unprecedented. We think it's like an earthquake, not just for our strategy, actually. We now think the earthquake is rolling off of our strategy and into other strategies. And those that are cyclical, we think, are going to face some quite severe challenges during the next, I'm going to say, 6 to 9 months.
She ain't wrong. Now, Cathie mentioned the Fed has increased interest rates 19-fold. 19 times, not 19%. 19 times. That wasn't a slip of the tongue. 19 times. I still just cannot understand the insanity, but I've said my bit on that. The point that Cathie was making here is that the herd mentality in the stonk market and equities markets is as follows. Interest rates are going up, therefore we need to sell growth stocks because that's what we do when interest rates are going up. Let's sell growth stocks. And that happened across the board. I think this was a primary reason we saw Tesla plunge by around 80% from recent highs. This is important to understand. Tesla's stock price went lower, not because Tesla was failing to execute, not because the competition finally came for Tesla rather than all over themselves, not because Elon Musk was distracted with Twitter, you fucking morons, but because enough big institutional investors and other players in the marketplace know that when rates go up, you must sell growth stocks. During this period of time, Tesla continued to execute, print insane amounts of money, grow at a ridiculous rate, maintain their competitive position, accelerate, innovate, yet the stock collapses about 80%. Amazing opportunity for those who weren't overcome by fear. And I suspect when rates start going down again, of course, who knows, maybe they'll keep going up forever, we're likely to see the reverse. Of course, I don't think the emotional babies who were blaming Elon Musk because Tesla stock was going down will ever realize the reason that the stock came down wasn't necessarily because Elon had some opinions and did some things and bought Twitter, but because everyone was dumping everything to do with growth stocks, and Tesla is the growth stock of all growth stocks.
Well, if that's the case and cyclical is under pressure because of the economy, because of the Fed, I mean, why have you been adding Block, for instance, the last few days? I mean, really amassing a pretty sizable position in this company, which is so tied to consumer discretionary spending.
Exactly, Cathie. Why would you buy something that's on a massive discount right now? it's not like you have a 5-year investment horizon, and if they're cheap now, they probably won't be cheap in 5 years, and therefore that's a great opportunity to buy, is it? Why are you buying now, Cathie? I don't understand.
Yes, what we're seeing with Block, Square, Cash App, we're seeing two things. It is reducing the cost of financial services, and so more people are flocking to it. And in fact, it's developing a closed loop ecosystem, and we believe could be one of the big winners in the digital wallet space, where it won't even have to interact, where their clients won't have to interact with banks. Cash App and Square will take care of that and really become the financial services company. So, and what that does is takes the number of toll takers, if you have a closed loop ecosystem, the number of toll takers in a transaction between a merchant and a consumer drop from 9 to 3. And you can find that analysis in our Big Ideas 2023 on digital wallets.
Cathie, it's David. I am curious as well to get your take on AI. There's been a great deal of enthusiasm generally seen in a number of different stocks with the obviously introduction of ChatGPT 3, 3.5, 4.
There's no question there has been a paradigm shift, an absolutely insane surge in AI capabilities in the last 6 to 12 months, particularly language-based AI models. And there's a running joke now, especially on Twitter. In essence, how do you double the valuation of your company? Well, just tell them you're using ChatGPT. The irony of ironies, of course, is that the market seems to be forgetting that Tesla is the world's leading real-world AI company. I've mentioned this before, but it's kind of important. Breakthroughs in language-based AI models are being used in Tesla's full self-driving software. This wasn't expected. I wasn't expecting this, but it has happened. Tesla's already told us over the last 1 year, they've implemented new breakthroughs in language-based AI models in their own neural networks, helping to improve the capabilities of their full self-driving software. The progress of AI is converging to a single point of general capabilities, and many of the breakthroughs that are happening now are surprisingly effective in other domains. Yet again, how many analysts on Wall Street are talking about Tesla's AI capabilities, their data lead in autonomy? How exactly did these language-based AI models get so good? Data. They got trained on a ton of data. Who else has a ton of data? Tesla. Their fleet, well in excess of 3 million vehicles on roads, collecting data to train their full self-driving software. To paraphrase Cathie Wood, hello people, are you listening? Oh, P.S. Full self-driving, that's never going to happen. You're an idiot. Maybe next century.
How does this, in your opinion, sort of sort itself out? And where is, again, are you putting your money to sort of support this thesis that it is a new world we're entering?
Well, I think because of OpenAI and ChatGPT, we think the good news there is it has captured the imagination of consumers and investors very quickly. So that's exciting. We've been talking about AI and all of the incredible breakthroughs we've seen over the last 3 years. But finally, ChatGPT has raised its visibility. So the natural beneficiaries, and many people own these stocks, are Microsoft and NVIDIA. But, in many ways, compared to our stocks, we don't own those two in our flagship. Those are the very obvious plays, and investors are paying for them from a valuation point of view. We think the overlooked beneficiaries are those that have proprietary data. And if you take a look at our portfolios, you will see companies that have proprietary data that will be activated by artificial intelligence.
Well, what do you know? Cathie Wood seems to be under the impression that companies who have proprietary data will benefit enormously from the surge in AI capabilities. Now, for those of you that don't know, proprietary data means data that you have that no one else has because it's your data. For example, hypothetically speaking, just imagine there was a company with millions of vehicles on roads covered in sensors collecting data, proprietary data that they have and no one else has, allowing them to train their full self-driving software. This would be an invaluable competitive advantage. Of course, no such company exists, unfortunately, otherwise I'd probably buy their stock, but they don't. And the value of such proprietary data cannot be overstated. Let's just imagine a hypothetical scenario in which there was a company, like the example earlier, with millions of vehicles on roads covered in sensors collecting proprietary data to train their software. You then want to ask the question, given the importance of data to training neural networks and improve their capabilities, if company A happens to have an enormous amount of proprietary data, the question you'd want to be asking is, are there any other companies on Earth attempting to solve the same problem who have any chance, any reasonable chance at all of accumulating a comparable amount of proprietary data over a reasonable time frame? And if the answer to that question would be no, then you've discovered company A would have what we might call an unassailable lead. But unfortunately, like I said, no such company exists, which is why I'm all in cash, because cash is not trash.
So if you look at ChatGPT, that kind of AI product or service, I should say, is going to be commoditized in a way, and the real beneficiaries are going to be companies who have AI expertise, domain expertise, and critically, a large body of data. And we think Tesla, the largest position in ARKK and ARKQ, and we even own it in ARKW because it's an AI company, it is probably one of the most important AI beneficiaries in the form of autonomous taxi platforms, ultimately, which are powered by AI.
Cathie Wood's such a dumbass. She thinks that Tesla has proprietary data and that they're going to be a primary beneficiary and that they're a real-world AI company. What an idiot.
Got to ask you about Tesla, Cathie. I know you're one of your favorites and your top holding still. Always a battleground. The latest concern from investors is about margins. So they've been taking these price cuts, which we debated last time. And even if that's catalyzing demand, at what cost? Is that a reason for concern?
Well, I think Tesla has, and Elon Musk in particular, has said that he will pass along any cost declines that Tesla is enjoying. And I think that's what's going on right now. And I think he's in a position to drive prices down much more quickly than most other manufacturers, save for some in China.
Those are what's known as the facts. As I've said in the past, I believe over the long term, Tesla's gross automotive margins will hover around the 30% range, maybe even as high as 35 to 40%. And this doesn't come out of my ass. I've thought about this. I've thought about the innovations in manufacturing. I've thought about the price point Tesla will need to be able to sell vehicles for with those margins, how much I'll need to be able to produce them for to be able to address, let's say, 80% or so of the vehicle market. Unlike internal combustion engine vehicles, a very mature technology, EVs are brand fucking new. A huge amount of innovation is yet to take place in terms of how to manufacture these. Shout out to Tesla's Investor Day 2023, where they unveiled plans to literally halve the cost of producing a compelling electric vehicle. And that's the next vehicle they're going to be producing, not the generation after that. Oh, you do realize there's going to be a generation after that, right? You do? Good. Later this decade, I believe, Tesla will be able to produce an extremely compelling electric vehicle for about 35 to 50% cheaper than the next gen vehicle that's already 50% cheaper than today's generation. They will not need to sell the vehicles that cheap. In contrast, outside of China, as Cathie Wood mentions, there aren't any other automotive manufacturers making any money selling electric vehicles. Their margins are negative, not even 0%. There are many people out there in the marketplace who suffer from small brain syndrome, who see Tesla's margins temporarily declining, and their first and only thought, because thinking hurts, so minimize the amount of said activity, the only possible explanation is that Tesla's doomed, because they're passing on cost savings to consumers and adjusting pricing dynamically around incentives phasing in and out, and so on. You must look at the big picture. Tesla's the only company outside of China making electric vehicles that has any pricing power at all. Tesla could slash the prices of the vehicles significantly lower and still make significantly more profit than anyone who makes ICE vehicles. And obviously, they're making more profit than anyone makes on EVs outside of China anyway, because no one's making any money on them besides Tesla. So you've got to think about this, big picture. If consumers want EVs, they do. If the prices of EVs are declining precipitously over time, they are. And if there's only one company outside of China who has the ability to reduce prices on their vehicles while still making massive profits on every vehicle sold, how does the so-called competition compete? The answer is they don't. Everyone is so focused on Tesla's margins and forgetting what this means for the rest of the automotive industry. They have industry-leading margins. They have insane pricing power. It's not a level playing field. Tesla has an insane unfair advantage. Tesla can turn the screws. Their goal is to scale up production to 20 million vehicles per year by 2030. There'll be points in time between now and then where their gross automotive margin in a single quarter will be over 30%. Maybe there'll be occasions where it's under 20%. What matters most is how many vehicles is Tesla selling? How big is their install base? How big is their fleet of robots collecting data, that proprietary data, to train and improve their autonomous software? This is why I've been saying now since last decade that Tesla has won the decade, as in the 2020s. It's now just a matter of watching this play out. Remember, each Tesla vehicle on roads is collecting data. That data alone is probably worth thousands of dollars per vehicle. This is proprietary data. It doesn't have a valuation. There's nowhere in Tesla's financials every quarter that says proprietary data, value, billions of dollars, bitches. But it is worth billions of dollars. And each active Tesla on roads in the future is a potential source of high margin, almost pure profit software revenue. Subscribe to FSD, buy a game, an app, unlock new features and functionality, performance updates over the air. This is not captured at the point of sale. This isn't part of the gross automotive margin. So, oh no, Tesla's margins have gone from 30% to 25%. Oh no, it's the end of the world. Well, hang on a minute. Throughout the lifetime of ownership of that vehicle, is it possible that the customer will actually buy some software, almost pure profit, meaning the actual margin on this vehicle is significantly higher than the gross automotive margin at the point of sale? The answer is yes. Many people aren't getting this because they think about Tesla like a car company. They're not. They're a software company. They make computers on wheels. They're an AI company. This will become increasingly more apparent over time. Do some simple math. Just imagine in a few years' time, Tesla has a fleet of 10 million vehicles on roads. Run through the exercise. What if, on average, every customer who owns a Tesla at that point in time, all 10 million on average, spends $100 per month on software? Now, I'm not saying they will. And some customers won't, but there might be some customers who are spending more than that. Do the math and see what happens. That's the prize on which you should keep your eyes. It is in Tesla's best interest to sell through all of their production. 1, to put more vehicles on roads to train their autonomous software. And 2, to put more active users on roads who in the future may purchase software, options, upgrades, etc. straight to the bottom line. Instead of thinking about what is Tesla's gross automotive margin, you should be thinking about, are there any other companies on earth who can make money after they've sold an electric vehicle to a customer? And are there any companies who have a huge fleet of vehicles collecting data to train their industry-leading software? If no, it's something to consider.
And I think there's deflation in auto prices taking place in China. I think Tesla led that and BYD followed. And so there's a deflationary tug there, which is actually going to accelerate the shift from gas-powered vehicles to electric vehicles, which is something that Tesla wants. So we think the mistaken assumption here is that Tesla has to cut prices because of competition. Tesla, we think, can drive prices down because its costs are moving down, particularly battery and drivetrain costs, faster than most other manufacturers.
Those are also what's known as the facts. Tesla has the pricing power. Tesla is dictating terms of the entire EV industry. Outside of China, no one's making any money on EVs today. If Tesla cuts prices, and these companies are already losing money on every vehicle sold trying to compete with Tesla on price, and Tesla cuts prices, they need to cut prices further, they lose even more money, they go bankrupt. The only way these companies can compete with Tesla on pricing, well, I mean they can't, but in theory, would be to A, steal all of Tesla's employees, 2, steal all of Tesla's data, steal all of Tesla's proprietary manufacturing systems, tools and techniques, completely change the culture of their company, scale up production to a few million electric vehicles per year, but just a few models, so there's more parts in common, you benefit more from economies of scale, build a time machine, go back in time, lock in huge supply contracts for materials and batteries, spend the requisite tens of billions of dollars in many years getting to that point in time, and then they would have the opportunity to also be competing on pricing. It just doesn't end well. Tesla is swinging around and turkey slapping the entire automotive industry with their gigantic PP, pricing power. There's nothing anyone can do about it. And spoiler alert, Tesla's PP will continue to turkey slap everyone in the automotive industry indefinitely.
Cathie, it's David again. I get this question from a number of your holders in the flagship fund, which is simply how expensive it is. Your ratio's double the average ETF, and your performance, when we look at it, at least over the last couple of years, is in the bottom 5%. How do you justify what the FT talked about as much as $300 million in fees going to you, despite what has not been good performance?
Well, we have a 5-year investment time horizon, and believe me, the last 2 years, this earthquake caused by interest rates put a dagger into our strategy. We believe that we're on the other side of that now, and that valuation that you're talking about really is a very short-term way of looking at our portfolios, and not the correct way.
Exactly right. The wrong way to think about ARK Invest and Cathie Wood is through a short-term lens. And as they've been saying publicly, from day one, they have a half-decade time horizon, 5 years. Of course, the Fed's insane ratcheting up of rates. I mean, again, I could never have predicted the amount of rate increases because of the consequences. Apparently, the Fed is unaware of the consequences, or they want them to occur. Not sure which. And naturally, because of the hive mind in the stonk markets, rates go up, growth stocks get f***ed. ARK Invest owns only growth stocks, so they got f***ed from all directions simultaneously without consent for an extended period of time. Doesn't sound like much fun.
Closest you'll find to a venture capital fund in the public equity markets, except, as I just mentioned to you, our companies have huge cash positions, right? And so our assumption, our working assumption is that our valuations, you say they're twice the average now, we assume that they're going down to the market in 5 years. And we are looking and we require a minimum 15% compound annual rate of return over the next 5 years. And we think that the stocks in our portfolios, based on our research could be wrong, but I think it's been better than most when you talk about electric vehicles, you talk about AI, you talk about sequencing technologies, you talk about blockchain technologies. This is where the world is going. And it is going to disintermediate and disturb and disrupt the traditional world order. And so we think our companies and our stocks are on the right side of change. They assume massive multiple compression. And we also assume that our companies will enjoy what we're calling exponential and super exponential growth. Many people don't understand what those concepts are because we have been living in a linear growth world for so long. And so if we're right, you look at our electric vehicle forecast, for example, we believe that electric vehicle sales will move from 7.7 million units last year to 60 million in 2027.
Just in case you missed that, ARK Invest expecting 60 million electric vehicles to be sold in 2027. And these are actually very close to my own estimates. I've shared them previously. My estimates are a couple of years old. It's just a coincidence, but we ended up on a very similar number. Now, in fairness, it could be a couple of years late. Maybe it's 2028. Maybe it's 2029. But the point isn't how perfect is the prediction of ARK Invest. The point is, how close are they versus the so-called experts who today, God damn it, in many cases, think less than half of all new vehicles sold in 2030 will be electric, which would be, give or take, let's call it about 40 million vehicles. 3 years after ARK expects 60 million. This disconnect is what's known as a gigantic opportunity. Of course, ARK could be wrong. In fact, they will be wrong. But the question is, how wrong will they be versus the consensus? Because like I said, the gap between actual reality and consensus right now, I believe, is enormous. And that gap is opportunity. I'd just like to make a point. This is from Moron Stanley back in 2014. Tesla will not be building 500,000 cars by 2020. Moron Stanley, lead auto analyst Adam Jonas, published a research note to clients on Wednesday in which he expressed skepticism about Tesla's stated goal of building 500,000 electric vehicles annually by 2020. By the way, spoiler alert, they got there. And that was despite the fascist shutdowns during the scamdemic, preventing them from producing probably about 100,000 more vehicles than they would have otherwise. Who got it right? The so-called expert or the company who set a public goal and achieved their publicly stated goal? It was the latter. Oh, but it gets better. Per my tweet, I promised to stop calling them Moron Stanley the first time they overestimate Tesla. Last I heard, they're expecting around 6 million deliveries from Tesla in 2030. In 2021, they were at 5.2 million. In 2020, they were at 3.8 million. Okay? 3 years ago, Moron Stanley thought Tesla would be selling 3.8 million vehicles in 2030. 3 years later, their estimates have almost doubled. They're not up 1%, 2%, 10%, 50%. They're up about 100%. This is the point that I'm making. There is still a gaping chasm between consensus estimates from the so-called experts and what's actually going to take place. And this is an enormous opportunity that people just aren't getting.
That's exponential growth. What does linear growth look like? And this is what most, the consensus is. They say 20 million. If we're right, there's a huge gap there that our stocks are going to enjoy filling.
Must not make jokes about filling gaps. Oh, we're recording. So I think Cathie Wood just said what I just said. Probably should have watched this video before I reacted to it because I basically just stole her glory. But yeah, again, the point. Consensus versus reality. There's a huge gap. The market doesn't get it. It's a huge opportunity.
And if I hear you correctly, then you're saying your expense ratio obviously will decline as your performance gets better.
No, I thought you meant valuation in terms of the valuation of the portfolios.
No, I was talking about your actual expenses, the fees that you charge your investors.
Well, you get what you pay for, right? So you're talking about ETFs that are more passive or self-indexed and automated, frankly. Ours are active, fully active, and our expense ratio, if you compare our expense ratio to mutual funds, all in expenses, we believe we're half the cost of mutual funds. And the end investor knows it, because many companies now, it's taken a long time, and these are truly active managers, are starting to move towards the ETF for wrapper. Why? For 4 reasons. Liquidity, more liquidity. You can trade them all day long. More tax efficiency by far. We have built up in ARKK more than $2 billion of tax losses for obvious reasons that we can apply against future gains. They are more cost effective, which I just mentioned a while ago. And there's one more that escapes my mind. But 4 reasons that the ETF wrapper is a better wrapper than mutual funds, although mutual funds are much better for 401k plans and others just because of the way the technology is set up. We hope that changes as well.
No, we are showing a 5-year chart.
Transparency.
We're showing a 5-year chart, Cathie, and the S&P is up more than 40%, and your ETF is down over that period. I know that's the way you measure it, but it has been significant underperformance even in that time period.
Yes, and we've never had a period where interest rates have gone up 19-fold, which would, again, put a dagger in a strategy like ours.
Once again, Cathie Wood's right. The insane rate increases, a 19-fold increase in the span of almost no time, has crushed multiples. Multiples have nothing to do with the company's execution, their proprietary data, their competitive advantages, their pricing power, nothing. And this is why it's important to keep eyes on the prize. My Patreon supporters will note, when rates started going up, I didn't suddenly start adjusting my Tesla price targets down because 1, they're not predictions of what the stock's going to be worth. They're my assessment of what a fair valuation is based on the numbers in my valuation model. How many deliveries, gross automotive margins, they produce the price targets. Most analysts on Wall Street started cutting their price targets, and many of them in the short term look like they're super smart because, oh look, the rates went up, my price target went down, and Tesla went down, I'm a genius. But they missed the big picture. The intrinsic value underneath didn't change. Tesla's execution remained near flawless. That's what matters. And so Cathie Wood, ARK Invest, their funds have been absolutely crushed. Rates going up equals multiples down equals the value of the stocks collapsing. But the companies continue to execute behind the scenes. And believe me, ladies and gentlemen, there will be a moment of retribution when rates start coming back down after the Fed has done their best to destroy the US economy. They start reversing course. We're going to see the exact same thing in reverse. And suddenly, all the analysts will be chasing after Tesla stock with their price targets. And I, having made no meaningful updates to my valuation model, which produces the targets, because there'll be no meaningful changes to my delivery estimates, my gross automotive margins, or any of the other estimates, I'll begin to look a little bit less insane.
Relative to all others. If we're on the other side of that, and we were the prime victim, and I don't mean personally, I just mean interest rates would hurt a long duration strategy like ours, just like it killed long-term bonds last year, which performed the worst they have in, decades and decades, if not hundreds of years. We should be the prime beneficiary. So I think you're looking backwards at something that did happen. We could not believe that the Fed was taking interest rates up so much.
Makes 2 of us, Cathie. I mean, I just literally cannot believe what we've seen and what we're still seeing. Another 0.25% increase today. Now, it's possible that I'm moron. I don't know anything about anything, but I mean, if you're trying to fight predominantly supply chain disruption-induced inflation by causing people to default on mortgages, to lose their homes, businesses to blow up, to kill the capital markets, to kill lending, to kill the venture world, like, somebody please explain.
Let me just give you a sense of what kind of heart attack this is, or earthquake. That's a better analogy. If you look at what happened in the last year to interest rates, up 19-fold, a lot of people, and the inverted yield curve that started last July flashing red, the inverted yield curve, the week before the crisis, the bank crisis, the inverted yield curve was more than 100 basis points. Hadn't seen that since 1981. Everybody, the light bulb went on. And everybody said, okay, well, it's because they're being as tough as Chairman Volcker. No, they were being 4 times tougher than Chairman Volcker. And the way you measure that is 100 basis points or 1% on a 4% long-term bond yield is 4 times more than 1% on a 15%. So that would be 1 over 4 is 25, and 1 over 15 is somewhere in the 6 to 7 range. So that's if you use the Richter scale, yes, Volcker had a Richter scale of 6.5 or whatever. And I know what that is. I'm from Southern California. I've been in a 6.5 Richter scale. This was 24, and we're seeing the ramifications now, and they're deflationary.
Now, I've got to say, it's been quite interesting, dare I say amusing, to watch many people roasting Cathie Wood and ARK Invest over the last year or so as their funds have been crushed. Most of these folks are too stupid to realise that what they're roasting is not ARK Invest or their strategy, but the Fed. As I mentioned, the hive mind in the stock market, rates go up, growth stocks go down. Rates go up 19 times in the span of 2 milliseconds, growth stocks go down a lot. Many of these people suffering from SBS are confused at the performance versus the strategy. As Cathie mentions, the underlying companies are flush with cash, they're disrupting, they're innovating, they have proprietary data, they're going to upend everything, they are disruptors. Yet the market, in its fear-induced panic and delusion, has completely lost sight of this fact, and instead is rewarding the very companies and industries that are currently being disrupted by the disruptors and penalizing the companies doing the disruption. It's just unbelievable. Just imagine, it's 100 or so years ago. What we've seen in the last 12 or so months is the equivalent of automotive stocks, which were disrupting the horse and carriage, get crushed while the horse and carriage stocks have soared to new highs. I don't know how else to explain it. This is why it's so important to have conviction in your investment strategy. We saw so many people dropping like flies. And then, of course, there were many extremely arrogant geniuses out there who thought they could time the market, and some of them probably did time the market through luck rather than good management. The emotionally induced fear, panic, and absolute brain damage that permeated the stock market. It's been a fascinating case study in human psychology over the last 6 or so months. Watching people panic sell Tesla stock near $100 per share because out of nowhere they suddenly, due to fear-induced brain damage, formed the delusion that there were issues with demand. This is why it's so important to have a thesis and know why the you are investing in the first place. Do the numbers. This is why I have estimates for EV adoption into the future. This is why I'm able to tell you guys that my own estimate for 2027 is around the same as ARK's. It is a coincidence, but we're both around 60 million units because I've done the exercise. And how did I get to this point? I factored in cost declines, therefore affordability. That issue is solved. By the time EV production scales up to a point where demand might start to be an issue based on current pricing, it will no longer be an issue because of economies of scale, more innovations, battery cost declining, and so on. I cannot believe the number of people I've seen over the last few months who suffered from such all-encompassing fear-induced brain damage that they either forgot the homework they'd done, they'd forgot the numbers they did, or they were exposed for not having done any thinking or numbers in the first place. I'm not sure which is worse, to be honest. While many were panic selling, crying, asking for daddy to hold them, deciding that the internal combustion engine would be around for another 100 years after all, I was buying hand over fist with every spare cent for myself and for family. I have a fairly high level of conviction that my decisions to continue buying hand over fist while many investors were panic selling near 2-year lows will age rather well. We'll just have to wait and see. Now, in fairness, full disclosure, I did actually have an unfair advantage. What would that be? Well, 1, I have a brain, but more important than that, 2, it actually works. And the reason my brain works is because I give my body the fuel, the resources, the nutrients, the minerals, the vitamins that it needs for optimal performance, including enough energy to actually use my brain and not to hurt too much. That's why I take Athletic Greens AG1 every day and have been doing so now for almost 2 years, which coincidentally covers about the same time frame that the Fed seemed to be intent on destroying the US economy. While others were panicking, I continued to buy Tesla stock with every spare cent. Maybe it's a coincidence. It is a coincidence, but I can say for sure, Athletic Greens AG1 certainly didn't hurt and certainly didn't impede my ability to think clearly. Here's what some viewers of this very channel have to say about AG1. Been taking AG1 for just over 2 weeks now. Incredible difference and no more afternoon fatigue. Been taking AG1 daily and realized I fall asleep better and faster, feel more focused and have better digestion. AG1 has given me a lot more energy. I am now on month 3 with AG1 and it's really working for me. So impressed I've bought it for both my parents. 3 weeks into AG1 and will not go back. Sleep and feel better. These past few weeks, I've noticed how much more I love working all day, every day since the first couple of days of trying it. It ain't no placebo effect. Also, a positive mood toward myself and others. So what are you waiting for? Head to athleticgreens.com/SMR or click the link in the pinned comment and start your daily health habit now. Alternatively, if you feel and perform your best already, you're functioning optimally, don't bother. Just doing my best to lead a horse to water. It's up to you whether or not you'll drink, but I do recommend it. There's a 90-day money-back guarantee, so if you don't feel and perform better, what's the risk? And don't forget, if you'd like to unlock over 300 exclusive videos, plenty of hot takes that are too spicy for YouTube, and optional access to my Tesla valuation model, head over to Patreon with the card in the corner or the link in the pinned comment, and I'll see you over there. Love ya.